Hi traders, well we're looking at the interest rate markets once again, but what we've seen is this kind of nirvana backdrop playing through, resilient growth data coming through, inflation that's trickling down towards target and very strong labour markets playing through, equity markets are feasting on that. Anyway, it's a big week ahead, there's a plenty going on this economic calendar. Take a look at the video and I'll see you on the flip side. Yeah, morning traders, welcome to the week ahead with a specific view on the interest rate markets and how they're sort of transcending into risk assets. Now, I think the new dynamic we've been seeing is this kind of resilience in the data. People have been pushing back on the recession trade that some people have positioned their portfolios for. We've got this kind of nirvana goldilocks scenario playing through at this precise moment where we're seeing growth data points clearly showing positivity. We've seen that in the Q1 GDP revisions in the US. New home sales numbers were much better. Durable goods numbers look pretty good. Consumer confidence has rebounded at a time when core PCE in the US came out slightly below expectations at 4.6%. We've seen slightly below expectations numbers in Tokyo core, EU and Canada core inflation numbers as well. Now that's allowed all parts of the US yield curve to move higher. But equity markets continue to be resilient in the face of that high discount rate. Long duration assets continue to rally despite the discount rate lowering the net present value. And that's something that's really interesting. As long as the growth dynamics hold up and inflation is trickling lower, I think we can absorb these higher rates. And that's something we're watching this week. Now, what are we watching? Specifically, I think the growth dynamics are very much in play. We're therefore watching the ISM manufacturing numbers in the US. We are expecting that to improve slightly, that pace of slowdown to improve slightly to 47.2. We are going to be watching that prices paid subcomponent, which is expected in at 44. Now, if we were to see a reading above 50, obviously that would be a big surprise, but I think that would continue to show solid rebound coming through in growth. And I think the market would look at that very, very closely indeed. We've got factory orders playing through, but then it comes really down to the labour market. We're going to be watching the ADP private payrolls numbers, the jobless claims, and then the non-farms on Friday will be the marquee event risk of the week. Now, I think the market will be very happy with a high level of employment. That's something that's probably a bit of a new dynamic where we just wanted to see a bit of a softer labour market read. But I think now what we've been seeing is that the market's very happy with a high level of job creation. And the market consensus is around 225 at the moment, with the unemployment rate to be at 3.6%. And that's conditional on the average hourly earnings numbers staying fairly subdued. Now, we are expecting that at 4.2%. Anything below that with a high level of job creation will be very positive for risk assets, and we'll continue to see the NASDAQ and risk and growth assets continue to outperform there. We are watching the front end of that curve. Twos, can we push into 5%? Can we get tens above 4%? That's something we are going to be watching very closely indeed. Now, in terms of the rates markets, how is this all playing out at the moment? Well, we can see for the 26th of July FOMC meeting, currently 21 basis points being priced in there. So nearly a done deal in the market's eyes that we get a rate hike in that situation. We get a step up of about 6 basis points for September, so not really a huge amount expected there. But it's really in November then, which we're looking at in terms of terminal pricing. That's something we are. Potentially there's a trade in there for rates traders. Could we push up to about 560, which of course is the Fed's dots? So we're still trading about 20 basis points shy of the Fed's dot plot projection for the end of the year. So 540 is the terminal rate, and then we sort of trickle down to about 515 by March. So that's where the peak pricing is. Maybe there's a trade in there to get up to those levels. Now, in terms of Australia, obviously all eyes on the Reserve Bank. It's a line ball call. We've got 14 out of 27 economists calling for the rate hike, for rates to be on pause. And you can see that the rates market seemingly agrees there, where we've got the rate set around 417. So if you move that from the effective rate, we can see about 10 basis points being priced in for the RBA meeting, which gives you about a 40% chance of a rate hike playing through. So we could see some short-term gyrations playing through in the FX markets on the back of that. I think with that in mind, you want to look at really what's being priced throughout the curve and just see how that statement sort of marries up with that. Now, you can see terminal pricing for the end of the year around 455, which is where the effective cash rate could be going up to. So the market's betting that really we've got about 2 rate hikes left in us in Australia under the current policy, and that gets us to 455. So take a view on that. That feels about fair to me at the moment. We'll see what the statement says. If we get a rate hike, do they give the impression that there's probably one more left in them? In the UK, there's not really a lot to drive this week. We've got the S&P global manufacturing numbers and also composite numbers coming through. I don't expect them necessarily to cause major gyrations. It's not really through to the 11th of July when we get the jobs and wage data, which of course was such a big mover in the prior period. As you can see in the UK rates, though, we've got the effective rate at 494, which give us for the 3rd of August, we've got about 39 basis points being priced in. So the market's saying on balance, we expect another 50 basis point hike, which I think is probably the right call at the moment. I think there's probably, that front end rate can gravitate a little bit higher. And then we've got terminal priced at 622 at the moment. So, can that move up to say 650? We'll have to see what happens with that jobs number next week and then also the CPI the week after. So the market is saying that we've still got about 130 odd basis points left in us for Bank of England policy, but the market's pricing 39 basis points the next one. In Europe, you can see the next ECB meeting on the 27th of July, we've got 23 basis points. So again, the market's saying that it's pretty much a done deal that we're going to get 25 basis points from the ECB. Going to December by year end, and you've got the terminal or peak price at 388 as well there as well. So this week we are watching very closely what happens in the US. It's really about the labour market, and can we continue to see good growth data, falling inflation dynamics, and solid labour markets? If we can, then I think the US dollar should stay really stable, and equity markets should find buyers on dips. We'll see what happens there.